Hello everyone. This is my project on for the course Kafka Streaming API, and I'm going to be applying this to my area of expertise, which is equity derivatives. So I hope you learned something about equity derivatives to complement what you've learned in the class, and we extend what we've learned on Kafka and Spark streaming. So what I'm going to do here is I'm going to be building a pipeline to analyze the volatility of equity derivatives, which is a very big topic right now. We'll construct a pipeline to facilitate a methodology that I've set up, a very simple methodology, and it's going to join across multiple Kafka streams in streaming data frames. And what we're going to try to do is we're going to try to do a calculation, which is trying to calculate the S&P, the implied volatility of the S&P 500 from the components of the S&P 500, so we can compare them directly to see if there's any kind of dislocation in the market. The complex part is going to be how we pick out the right option from the option chain to identify which one to use in our implied volatility calculation. And I'm going to talk a little bit about this terminology for a few minutes, and then talk about the infrastructure of the pipeline that we built. And just one quick note is, hopefully everyone understands this is a illustration of Spark and Kafka, and people should not be using this for any trading strategies or investment strategies. This is a major simplification of any methodology that's used in practice, and you should not use this for any real financial decisions. So just a few words about equity derivatives. So what options are there are contractual rights for an individual who holds them to just be able to buy or sell a stock at a predetermined date and at a predetermined price, which is we call the strike price. The value of an option is determined by the spot price, which is the price of the security, underlying security, the strike price, the time left in the contract, interest and stock borrow rates, dividend projections, and volatility. Volatility is a good measure of how of risk in the instrument. Typically, volatility is implied from a model when we have all the other inputs. So volatility is the key input to the valuation, because it is a good measure of how much risk exposure there is, and with a lot of the things that are happening in the market right now, with interest rate rises and potentially impending recessions and things like that, the volatility tends to increase because the risk is going up. So this could be a good way to see if people are selling off in the market. So if we see a lot of high volatility in stocks as opposed to the index, it's a good indication that the market is that people are maybe panicking and selling off securities, and that will be reflected in the volatility of the options market. So that's why we'll look at this as a good measure. So yeah, I mentioned the spot price. The strike price is the price of the contract that the holder gets to execute, can buy the security at, or sell it. The term "at the money" is when the strike price is at the level of the current price in the market. So this is just a snapshot of what it looks like on Yahoo Finance, and Yahoo is going to be the source of our data for this exercise. So you can see there's different contracts on. This is on the S&P 500 tracker, and we can see that there are different contracts and there are different strike prices depending. The level is at around 411 on this date that I snapped this, and you can see the at the money level. We can see here, and we have Yahoo has given us an implied volatility as well, and we can see that from this you can tell that the at the money volatility level for about a 3-month out option is about 25%. So that's the number I want to I want to get that number from each individual stock that's inside each of the 500 stocks that are inside the S&P 500. I want to get that number, and I want to actually see if the index itself, if it is much above that 25%, if I actually calculate it from the components. So how we calculate it, this is a portfolio volatility calculation. So an index is basically a basket. So we have this linear algebra calculation, which looks complex, but it only has 3 inputs to it. So we can calculate the volatility of a portfolio or an index, which is a portfolio, by taking the weightings of the components. So how much weight each of the 500 stocks has in the index, times a matrix of volatilities. This is just a diagonal matrix of the individual implied volatilities or volatilities that we're going to try to source, and then this is multiply that by the correlation matrix times the volatility matrix again, and then transpose of the weight, and that will come out to be a scalar value. So if we take the 500 weights, the 500 volatilities, the 500 by 500 pairwise correlations, we multiply all that together, we will actually get a single scalar value. And that's the calculation I want to do. Okay, next I'm going to show how I source each one of these inputs. We'll be using Yahoo Finance for all of these. So this is all in a Jupyter notebook, but also it's on a Python file, which I'll run so we can show how it streams. For most of the inputs, we're just going to grab them, but for the implied volatility, we're going to stream it. For the easiest is the weightings first, which is we pull in the market capitalization of each company, which is basically how much each stock is worth, and we calculate each one's percentage as a whole of the whole of everything in the index. So that gives us the weightings of each stock within the index. So there's the data frame, and that'll get saved down. Then we do the same. We want to get the correlations as well. So to get correlations, we need to get the price returns. So I'm looking back 90 days and getting the close price from the Yahoo Finance download. And what we want is actually the log returns, the log daily returns. That helps normalize the calculation since all the stocks are at different levels. And once we get the log returns, which is quite easy, we can easily calculate the correlation, which is a pandas correlation function. We get a 504 by 504 matrix of correlations. Then for our back pocket, we get the historical volatility, which is just the going to be the variance, the standard deviation, actually, of the the spot price moves. But what's most important is we want the implied volatilities. So we're going to get the implied volatility change. So here's an example. If we can grab the this is American Airlines, quite a high volatility stock. If we grab one of the chains, what will happen is we'll get it'll cycle through each maturity and call and put, and it will get each chain. So it's gonna store and build out the full chain for everyone. And what we're gonna do is we're gonna cycle through each. This is what the American Airlines looks like. So it comes down into a pandas data frame. Okay, now I'll just show how it works live. Okay, so this is running. We run the Yahoo input streamer that I wrote, which brings in all the market capitalizations. It calculates, so it's now pulling in all the spot prices. The performance is actually it's noticeably slower when the market is live, which it is right now, but it's run the calculation. Shows a bit of the correlation matrix, and what it's doing now is it's quite slowly going through each of the individual 500 stocks, and what it first does is it creates a timestamp for when it grabbed them, and it fetches each one at a time, each chain one at a time, and then once it gets all the chains for that particular security, it sends off to Kafka. And now the rest of the application is going to try to figure out from the Kafka input how to select the most relevant option, so that we can grab the right implied volatility for the calculation to be done. So the challenge of this project is really to identify the right option to use for the implied volatility. So we're streaming each of the option chains right now over Kafka using the Python API, and what we want to do is choose amongst each of those chains which implied volatility is the one we want to use for our calculation. Remember, we saw that it was the 3-month volatility of the S&P was about 25%. So we want to find all the 3-month, all the options that are closest to 3 months in terms of the number of days on these chains, and we want to find the options that are closest to at the money. So for this example, this is the American Airlines. We can see that this 18 strike August 19th is the closest to at the money, and it has an 81.2% volatility. So we want to get that for each one. And the challenge that I had here was around self-joining. I needed to join the option chain back to different aggregations of itself. So, and this was really interesting because the way Kafka works is when you publish to a topic, you publish to the topic, it's not a message system. I can set up various consumer instances off the same topic which can continue to read. So what I've done is I've created a class which is basically a consumer which is going to read from the Kafka topic and do an aggregation and then publish to another Kafka topic, and then the next instance will join the original one back to the one before it. So for the first instance, for example, we take in the full option chain and we do a calculation to identify all the minimum number of days, and we group by and calculate the minimum number of days, so we find the best maturity for each option. And then we publish that onto a Kafka topic called best maturity. And then the next instance, aggregator instance, is going to identify, it's going to take the option chain again, and it's going to join it to the tagged maturities, so and filter down. So basically kind of an inner join to reduce the data set down to the ones with the best maturity, and then it's going to aggregate by strike to find the ones which have the best, the closest strike to spot. So we aggregate. So we end up with the option that has the best. We have the best strike in that maturity, and then finally we have a final aggregator which filters down, it joins back to the original, filters down best strike, best maturity, and we end up with one volatility. And then that gets streamed into the input store, which for this case is a file system. And then once we have that, it's just that we just do that NumPy matrix calculation to get the value. Now, to show this in action, I have a whole bunch of consoles open where I've set this up, and all the instructions to do this are in my report. But effectively, what we've done is I've set up all the Kafka queues, topics, and we know we have this streaming, the options data streaming right now. Each of these tabs is an instance of the Spark. The object, the class that I created, the aggregator class that I created. So we have the 3 levels of aggregations. We have those running, and what we can do is we can use the Spark, the Kafka console to see each one. So the different topics are all set up. So if I run this, we can see this is the this is the full option data full topic, which is getting the full chain. So you can see as they are coming in, you see these CDNS just came in. So these are feeding in through these messages are feeding in through the topic. And then the first instance is then doing an aggregation to determine the best maturity. So we can look at that Kafka topic to see the output there. So it's basically as the instance comes in, it determines this is the best maturity. Actually what it does is it tells for each maturity the number of days to the target, which is the 3-month target. So for this particular chain, and there's only 4 days between. There's only 4 days, but actually, so these are timestamps. They're not. These are actually the timestamps of when we get it. But we don't need to show the actual maturity of the option. We're just showing the number of days minimum. So when when that goes on to the next aggregator, it will join and say any options on that ticker that have 4 days are my best maturity, and it's going to filter them out. Then it does the same for the strike. So here, we for each underlying, and again we keep the timestamps through the whole process. We've at this stage identified the best maturity. It's all been filtered down for the best maturity. So this one you can see they're all summertime maturities because we picked a 3-month target, and we picked the strike. Actually, this is the minimum strike difference that we want to target, and then the next option chain will the next class instance will then identify all the options that have that strike difference, and it will filter those out, and then we'll end up with the best strike and maturity for each option chain, and therefore the best volatility. Okay, finally the results are all pushed into this directory input store. The volatilities are streamed into this folder, and the way Spark does with files, it actually creates files for each append action that it does. So there's quite a lot of small files that get written. So we end up here with a file which has the ticker and the volatility, and there's quite a lot of redundancy in these files. But what we'll do now is the volatility calculation will run the NumPy matrix calculation that we talked about. It concatenates all the files together, and we can continue to stream in options data all day long in a loop and continue to update this calculation. So we ended up with the volatility. It did the calculation and ended up with a single scalar value of an index volatility of 40. So that is significantly higher than the 25% that we saw before. So. And here's another Jupyter notebook which will show that calculation quickly. So it will get each of the key inputs, the weights, the correlations, and the historical volatilities and the volatilities. It will convert them into NumPy arrays and perform the final calculation, which is again it's just a simple matrix multiplication, and we get about a 40% volatility at the moment. And just to kind of interpret that a bit, so going down, I've also pulled down various historical lookbacks, and we can see so the volatility is significantly higher than the volatility we observed at around 25%. And you can see, looking back at the history, we're in a period of time here where volatility is increasing, it is on the upswing. But what does it tell us? That the implied volatility from the indexes are so much higher than that of the individual stocks is so much higher than that of the index. It's hard to actually make a good conclusion from that, because just from knowledge and experience that there is always a big difference. There is always a difference. The implied always trades at a level higher than the historical, because of the way people trade individual stocks. You can't actually replicate the index, so there's some basis, some additional risk in holding holding the stocks individually that's not accounted for in the ETF and the option on the index. So what we want to do is run this calculation for a long period of time and trend it and see if that difference is changing, and that would tell us whether it's high or not. But yeah, we are in a period of increasing volatility. As you can see, the blue line, which is actually short-term historical volatilities, are definitely on the upswing, because the market is in a downturn right now. Okay, that's all I had, and I hope you learned a bit about both options and Kafka and Spark. So thank you very much for listening to this. All of the materials are online, and you should be able to replicate these calculations yourself. Thank you for listening. Bye.